Hey traders, welcome back to the ComLucro channel. Today, we're continuing our technical analysis for day trader series with a deep dive into one of the most essential concepts, Dow Theory. We'll explore how Dow Theory helps you understand market trends and make smarter, more aligned trading decisions. As the foundation of trend analysis, it gives you the structure to trade with the market, not against it. We'll cover its core principles, like the three types of market movements and the breakdown of primary, secondary, and minor trends, and show how to apply them in day trading. Plus, we'll demonstrate how combining Dow Theory with tools like moving averages and volume analysis can improve your timing and accuracy. So why does it matter? Because trading with the trend is key to long-term success. By recognizing trend phases, you'll plan better entries, exits, and risk management. Building on that, let's now set the stage for what you'll learn in this chapter. We're going to explore Dow Theory for day traders, its core principles, how it helps you understand market trends, and how to apply it to refine your trading decisions. While we won't be covering specific strategies in this video, we'll focus on the foundational concepts of Dow Theory, such as the three types of market movements and how to identify primary, secondary, and minor trends. Mastering these principles will allow you to align your trades with broader market movements, improving both timing and accuracy. For this lesson, we'll use real market chart examples to demonstrate how Dow Theory operates in practice. We'll be using TradingView as our platform due to its popularity and ease of use among traders. Keep in mind that, although Dow Theory is a timeless approach, different platforms might display price data or trend analysis tools slightly differently. Being familiar with your platform's features will help you effectively apply these principles and interpret trends accurately for more informed trading decisions. Before diving into the technical aspects of Dow Theory, let's first talk about Charles Dow and why his work remains so influential in trading. Charles Dow, a 19th century journalist and co-founder of the Wall Street Journal, developed a set of principles for understanding how financial markets behave, principles that are now known as Dow Theory. His work laid the foundation for modern technical analysis and continues to guide traders in analyzing price movements and trends today. But why does Dow Theory still matter to traders in today's fast-paced markets? Because it provides a clear framework for understanding how markets operate through trends. It helps traders identify the different phases of market movements, whether in an uptrend, downtrend, or consolidation. These principles aren't just relics of the past, they offer practical insights into how trends form, evolve, and eventually reverse. Recognizing these phases allows traders to make more informed decisions about when to enter or exit a trade. In financial markets, Dow Theory's emphasis on identifying trends helps traders pinpoint potential entry and exit points. The three types of trends, primary, secondary, and minor, are particularly important for day traders, offering insight into both the long-term market direction and the shorter-term fluctuations traders can capitalize on. For example, while a primary trend might indicate a long-term bullish market, day traders can focus on the minor trends within it to find profitable, short-term opportunities. To illustrate how recognizing cycles can align with trend-based decision-making, let's hear from Larry Williams. He explains how a recurring 13-week market cycle can help traders anticipate medium-term movements, perfectly aligning with Dow Theory's concept of secondary trends.
I'm going to give you my secret of short-term and intermediate-term cycles right here, right now. It's a 13-week cycle. Why 13 weeks? Some magic number? No. What happens every 13 weeks in the stock market? Companies report their earnings. So because of that, there's a real strong, dominant, natural cycle of about 13 weeks in the Dow Jones Industrial Average, the S&P 500, in fact, most all stocks, especially ones with dividends. So you need to look at your stock, your investment program, versus the 13-week cycle. Most software will let you put that on your chart or just look at it yourself. About every 13 weeks, these stocks start substantial moves. Pay attention to the 13-week cycle.
By understanding how trends develop and applying Dow's principles, traders can navigate market movements with greater confidence, aligning their trades with the dominant market direction. Now let's dive into one of the core elements of Dow Theory. The market has three movements. According to Dow Theory, the market doesn't move in a straight line. Instead, it operates in three distinct types of movements that every trader should understand. First, we have primary movements. These are the long-term trends that last for months or even years and define the overall market direction, whether bullish or bearish. For day traders, even though the focus is often on short-term trades, understanding the primary trend helps align your trades with the broader market, reducing risk and increasing your chances of success. Next, we have secondary movements. These are medium-term corrections or pullbacks within the primary trend, typically lasting anywhere from weeks to months. Think of them as temporary dips in an uptrend or brief rallies in a downtrend. Recognizing secondary movements is crucial for timing your entries and exits, allowing you to capitalize on short-term reversals without losing sight of the overall trend. Finally, there are minor movements. These short-term fluctuations last from days to weeks and are most relevant to day traders. Minor movements reflect the immediate price action within both primary and secondary trends. Identifying these smaller movements helps you make quick tactical decisions, providing more opportunities to profit from short-term market changes. Now let's discuss two recommended methods for analyzing primary, secondary, and minor movements, both of which can help you better understand market behavior and improve your trading decisions. First, let's talk about moving averages. One of the most effective ways to analyze market movements is by using moving averages. For long-term primary trends, many traders rely on the 200-period moving average, which serves as a key indicator for confirming the overall direction of the market. For example, if the price of an asset is consistently above the 200-period moving average on a daily chart, it suggests a strong upward trend, and traders may look for buying opportunities during pullbacks. Moving on to secondary trends, a shorter-term moving average, such as the 50-period moving average, comes into play, helping you identify pullbacks or corrections within the primary trend. Let's say the price has been moving above the 200-period moving average, but temporarily dips and touches the 50-period moving average. This could indicate a secondary trend, a pullback, within the larger uptrend, presenting a potential buying opportunity for traders who want to enter the market at a lower price. Finally, for minor movements, the 20-period moving average is often used to track short-term price action and guide intraday decisions. For instance, in day trading, if the price is bouncing between the 20-period moving average on a 15-minute chart, it can indicate minor fluctuations or intraday trends that day traders might capitalize on for quick, tactical trades. By observing how the price interacts with these different moving averages, you can better align your trades with the dominant trend and spot potential turning points in the market. For example, if the price breaks below the 200-period moving average, it could signal the end of a primary trend, prompting traders to adjust their strategy accordingly. Now let's shift our focus to how we can further refine our analysis using multiple time frame analysis. Here's how we apply this method in practice. The price of Bitcoin is currently in a downtrend on the daily chart, characterized by consistent lower highs and lower lows, which defines the primary trend. As our objective is to make purchases, we will focus on identifying a change in the characteristics of this primary trend, specifically by looking for a breakout above the most recent lower high resistance level. When this breakout occurs, it will signal a potential shift in market dynamics, indicating that the downtrend may be weakening. At this point, we will draw the Fibonacci retracement from the most recent low and closely monitor the evolution of the retracement until it reaches the 50% level. This allows us to pinpoint potential entry points for our buy positions, aligning our strategy with the emerging signs of recovery in the primary trend. By concentrating on these critical levels and the identification of a change in the primary trend's characteristics, we can effectively position ourselves to capitalize on future trading opportunities as the market begins to shift towards a bullish sentiment. Once the price reaches the 50% Fibonacci retracement in the primary trend identified on the daily chart, we turn our attention to the 4-hour chart, which represents the secondary trend. This time frame is particularly useful for spotting corrections or consolidations within the primary uptrend. By analyzing the 4-hour chart, we can identify key support and resistance levels and draw the downward trend line, allowing us to better understand the market dynamics and refine our trading strategy. In this secondary analysis, while the daily chart is in an uptrend, the 4-hour chart will reveal downward in the secondary trend, which can include corrections or sideways price action. This approach provides traders with the opportunity to enter the market at more favorable prices by identifying potential entry points during these temporary retracements, aligning our trades with both the primary and secondary trends. After analyzing the 4-hour chart secondary trend, we will shift our focus to the 60-minute chart to identify support and resistance zones. In this case, we are looking for a support zone that corresponds to both the 60-minute and 4-hour charts as the price continues to decline. Once these zones are identified, we will wait for a breakout of the resistance zone in the 60-minute or minor trend. When a breakout occurs, we will then apply and follow the Fibonacci retracement tool on the 60-minute chart. Once the price closes below the 50% retracement level, there are two ways to enter the trade. The first option, which carries more risk but offers a higher risk-reward ratio, is to wait for the price to hit the 50% retracement and then open a buy order when the next candle closes above this level. In this case, the stop loss would be set 1 pip below the 4-hour support, and the first target would be the 4-hour resistance. The second option, which is more conservative with a lower risk-reward ratio, is to wait for the price to regain strength after hitting the 50% retracement and break above the 100% retracement, i.e., the last high on the 60-minute chart. The stop loss in this scenario would also be set 1 pip below the 4-hour support, and the target would still be the 4-hour resistance. By using multiple time frames, you gain a clearer perspective of the market and can better align your trades with both short-term and long-term movements. In our analysis, we first examined the daily chart of Bitcoin USD to identify the primary downtrend and key support and resistance levels. Next, we moved to the 4-hour chart to identify corrections, waiting for the price to approach the 50% Fibonacci retracement of the primary trend. Finally, we shifted to the 60-minute chart to pinpoint minor support and resistance zones and prepare for a breakout. After the breakout, we applied the Fibonacci retracement tool to determine our entry, targeting the 4-hour resistance with a stop loss just below the identified support. In short, using multiple time frame analysis in conjunction with moving averages enables us to align trades with various trends. We start with the daily chart to evaluate the primary trend, then use the 4-hour chart to track corrections and fine-tune our entries on the 60-minute chart. Combined with Fibonacci levels, this approach helps us find ideal entry points, manage risk, and refine our trading strategy, offering a comprehensive view of market dynamics and improving decision-making. Now that we've covered the market's 3 movements, let's explore the 6 tenets of Dow Theory, which serve as the foundation for understanding price behavior in financial markets. These principles remain just as relevant today as when Charles Dow first introduced them. First, we have the tenet that the market discounts everything. This means that all available information, whether it's economic data, political events, or market sentiment, is already reflected in the current price. Instead of trying to predict external events, traders should focus on analyzing price action itself, since it encapsulates all known factors. This is why price movements are often considered the most reliable indicator of market behavior. Second, the market moves in trends. Dow Theory emphasizes that prices do not move randomly. They follow patterns that can be upward, downward, or sideways. Identifying and following these trends is critical because once established, trends tend to persist. This principle underpins much of technical analysis, helping traders make more informed decisions by aligning their trades with the market's prevailing direction. Third, there are 3 types of trends: primary, secondary, and minor. As discussed earlier, primary trends define the long-term direction of the market, secondary trends represent medium-term corrections, and minor trends reflect short-term fluctuations. Understanding these types of trends is crucial for executing effective trades, particularly when trying to align short-term actions with long-term market movements. Next, we have the tenet that trends are confirmed by volume. According to Dow Theory, volume acts as a powerful confirmation tool for the strength of a price movement. For example, in a rising trend, increasing volume as the price moves higher confirms that the trend is strong and likely to continue. On the other hand, declining volume during a price movement could signal that the trend is weakening, offering a warning to traders that a reversal may be approaching. Monitoring volume alongside price action helps confirm the validity of a trend. Another key principle is that a trend remains in place until a clear reversal occurs. This means that once a trend is established, it will continue until there are unmistakable signs that it has reversed. Traders often make the mistake of trying to predict the end of a trend too early, but Dow Theory teaches us to wait for clear signals before assuming the trend has changed. Patience is essential here. Only act when the reversal is confirmed by solid evidence. Finally, Dow Theory stresses that closing prices are more important than intraday movements. The closing price represents the final consensus of market participants, making it a more reliable indicator of the market's true sentiment than intraday fluctuations. Intraday price action can be noisy and erratic, but the closing price gives a clearer picture of the market's direction, helping traders make better decisions based on a more stable data point. For the day traders who need to open and close positions within the same day, it's crucial to monitor intraday trends while keeping an eye on how price action is developing toward the close. A strong close near the high or low of the day could signal continuation into the next session, while a weak close may indicate potential reversals or indecision. Even though your trades happen intraday, aligning your strategy with the momentum leading into the close can provide additional insight and help you avoid getting caught in erratic price swings near the end of the trading day. Dow Theory remains highly relevant in today's fast-paced markets, providing a timeless framework for understanding market trends. Despite technological advancements, the fundamental idea that markets move in trends still holds true. Dow Theory helps traders cut through daily noise and focus on larger market patterns, aiding in better trade timing by distinguishing between primary, secondary, and minor trends. It also encourages objective decision-making by waiting for clear trend reversals, reducing emotional reactions in volatile markets. To drive this point home, here's Phil Goedeker with a powerful take on why emotional stubbornness can destroy trades, and how a disciplined, trend-based mindset helps traders avoid costly mistakes.
Never, ever add to losing trades. You know, there's a reason the trade is going against you. You're wrong. I mean, it's all there is to say. You need to exit that trade and look for a re-entry. And don't ever say to yourself, it can't go higher. I mean, it can't go higher or it can't go lower. For anybody that says it can't go higher, put a chart of drives next to your computer from last November. For anybody that says it can't go lower, put a chart of drives next to your computer from, November 15th to, a few weeks ago. It's down 99.99%. There's a prominent hedge fund manager out there a few years ago that was bullish on Valiant. He was bullish in the 200s, bullish at 180, bullish at 150, bullish at 100, bullish at 80, 60, 40, 20. I think he finally sold at $10 or $15. Why? I mean, it's just stubbornness. And that's all it is to it. It's just stubbornness, in my opinion.
By respecting market direction and avoiding emotional bias, you not only protect capital, you trade with the trend, not against it. Now that we've discussed the relevance of Dow Theory in modern markets, let's dive into how you can apply these principles to your day trading. While Dow Theory was originally developed for long-term market analysis, its principles can be effectively adapted for shorter time frames and day trading strategies. For this example, I will utilize multiple time frame analysis, which we believe is a more effective approach than relying solely on moving averages. In this strategy, we will work with the 60-minute chart as the primary trend, the 15-minute chart as the secondary trend, and the 3-minute chart as the minor trend. It's important to note that this trading strategy is specifically designed for day traders who need to close their positions within the same day. The strategy involves waiting for a retracement of at least 50% on the primary, 60-minute, secondary, 15-minute, and minor 3-minute trends. After the price corrects by 50% on the 3-minute chart, you should wait for the first candle to close above this level before entering a buy position. It's essential to highlight that this strategy is valid for both bullish and bearish markets. Let's begin. On the Bitcoin USD chart, we identify that the market is in a downtrend on the 60-minute chart, primary trend. My objective is to identify a reversal to an uptrend on the 60-minute chart and subsequently look for entries on the minor trend, 3-minute chart. To facilitate visualization, I will draw downtrend lines and identify zones of support and resistance on the chart. Once the price breaks through the resistance zone, I will start monitoring the market with the Fibonacci retracement tool. As I track the market using this tool, we observe that the market entered a strong uptrend with a maximum retracement of 38.2%, creating a new support and resistance level on the 60-minute chart. It's crucial to note that while the market followed the direction I was expecting, it did not behave according to my defined strategy. I must emphasize that I should never alter my strategy out of fear of missing out, FOMO, or fear of uncertainty and doubt, FUD. Remember, the primary objective of a trader is always to preserve capital. It is infinitely better to miss an opportunity than to lose money. Continuing on, as mentioned, a new support and resistance level was formed. Therefore, the Fibonacci retracement should be adjusted to this new swing low and swing high. It's important to highlight that the Fibonacci retracement should always be drawn between the last swing high and low of the time frame you are monitoring. Now we can see that the price has corrected to 50% of the movement, so we will move to the 15-minute chart, secondary trend. On the 15-minute chart, we will identify the trend line along with support and resistance levels. We will apply the same rule of monitoring the retracement up to 50%. Once this occurs, we will then move to the 3-minute chart. As we can see, the price has retraced to 50%, and we will follow the same procedures on the smaller chart, 3-minute. Next, on the 3-minute chart, we will again identify the trend line for the movement, as well as support and resistance levels. Once the price retraces to the 50% level and the next candle closes above it, we will enter a buy order. The first target for this buy position could be the 161.8% extension of the Fibonacci from the 15-minute movement or the next resistance on the 60-minute chart. In this scenario, the risk-to-reward ratio will be much higher, but the trade may take longer to close. To protect yourself, you could decide that once the price reaches the 161.8% level, you will partially close your position and move your stop loss to break even. As the price increases, you can adjust your target according to the Fibonacci extensions and also raise your stop loss accordingly. Now that we've explored how to apply Dow theory in today's markets, let's step back and look at its benefits and risks. While it offers a solid framework for trend analysis, recognizing its strengths and limitations is essential. One key benefit is helping traders align with broader trends. By identifying primary, secondary, and minor trends, traders can improve timing and reduce risk, especially when spotting pullbacks within a larger move. Dow theory also adds structure by encouraging a focus on the overall trend instead of short-term fluctuations, leading to more disciplined entries and exits. Its emphasis on volume confirmation provides further clarity, helping traders validate trend strength based on market participation, not speculation. However, it's important to understand that Dow theory has limitations. One major risk is over-reliance. While it helps identify trends, it doesn't account for economic events, news, or market sentiment. Using it alone without supporting tools like candlestick patterns, indicators, or fundamentals can lead to missed or poorly timed trades. Trend identification can also be subjective, especially in volatile markets. Traders may mistake minor moves for reversals, leading to false signals and bad entries or exits. Additionally, volume confirmation can be unreliable in modern markets influenced by high-frequency trading. Volume patterns may not always reflect true trend strength. Now that we've covered the benefits and risks of Dow theory, let's look at common mistakes and how to avoid them. A major error is relying solely on Dow theory, ignoring sentiment, news, or technical indicators. This can lead to missed trades or poor timing. Instead, combine it with tools like moving averages, volume indicators, and momentum oscillators for better insights. Another mistake is misreading trends, confusing a pullback for a reversal. Dow theory stresses that a trend holds until clearly reversed. Wait for strong signals like trendline breaks or volume shifts before acting. Traders also often ignore volume confirmation. Volume is key for validating trend strength. Use tools like OBV or VWAP to assess market participation. Finally, failing to adapt Dow theory to today's fast-paced, algorithm-driven markets can limit its effectiveness. Enhance it with modern tools like real-time news and sentiment analysis to stay relevant and accurate. Now that we've covered common mistakes, let's review best practices to use Dow theory more effectively. Always pair Dow theory with other tools, like moving averages, trend lines, RSI, or MACD to confirm trend direction and gauge momentum. Be patient and wait for confirmation before acting on trend changes. Look for clear signs such as trendline breaks, volume spikes, or strong candlestick patterns. Use higher time frames, like daily or weekly charts, to filter out noise and spot major trends more clearly. Finally, apply solid risk management. Set stop losses and manage position size to protect your capital, even with strong signals. A stop loss isn't just a safety net. It's a discipline tool that keeps your account alive when trades don't go your way. To reinforce this point, here's Phil Goedeker with a clear and honest take on how failing to respect stop-loss levels can spiral into devastating losses, a reality many traders learn the hard way.
Stops are a must. I mean, we all have to use stops. Now, I personally rarely use hard stops, but I have mental stops on every position that I take. Basically, if something's breaking support or resistance, I usually just exit that trade. And I think most of us here need to have a mental idea in our head of where we're going to exit a trade, based on where it goes against us. How many of us here have ever been in a losing trade and we're down something small, maybe $5,000, and we think, I'm not going to cut it. I feel like this is going to be a winner, and we add to that trade. An hour later, we're down $20,000 to $30,000, and we think, wow, it's hard to, I can't cut it now. We hold it till the afternoon. Maybe tomorrow it gaps up, we're down $70,000, $80,000, $100,000, and we think, what the heck just happened? I could have cut that loss yesterday for $3, $4, $5 grand. Now I've given up 10, maybe 20% of my year just by being stubborn. Think about how much more money we could make at the end of the year if we just stick to some simple rules and cut our losses at an appropriate place.
Cutting losses early, as Phil suggests, is a discipline that separates consistent traders from those who rely on hope and emotion. It's a mindset rooted in respect for risk, one that aligns perfectly with the structure Dow Theory provides. To wrap up, Dow Theory provides a solid foundation for trend analysis and market behavior. When applied alongside other technical tools and backed by proper risk management, it can become a powerful part of your trading toolkit. Remember, the key to successful trading is not just following trends, but understanding how trends develop, evolve, and eventually reverse. By mastering these insights, you'll improve your ability to make well-informed trades and achieve long-term success in the markets. If you found this video helpful, be sure to check out other lessons in our course, where we dive deeper into technical indicators, chart patterns, and risk management strategies. These insights will further enhance your trading approach and help you build a solid foundation for success. Thank you for watching, and we look forward to seeing you in the next lesson.
I hope you enjoyed today's video. If you found the content useful or fun, please give it a like, as this helps the video reach more traders like you. Remember to subscribe to the channel and activate notifications to stay updated with the latest financial market information and trading tips. Sharing this video with your friends or on your social networks can make a big difference and helps our community become stronger. Your support allows us to continue bringing high-quality content, helping you make more informed decisions in the markets. Thank you for watching, and good luck on achieving excellent results in your trades.